Thank you for joining us on our first in a series of webinars on financial matters. I'm Claudette Christie. Today, we are going to listen to some presenters who have great experience in the field of investment and financial management. And they're going to be talking to you about how to manage when it's a challenging time, as we are in now with COVID. We want you to understand how to make sure that your money works for you. I have with me this afternoon Andre Yapp, and he's a senior research analyst at the Credit Union Fund Management Company. He has quite a wealth of experience in the field. And Andre, in fact, is one of the 4 competitors on the Masters program that has been running for about a year. And if you have been following that program, you will know that Andre is an expert in the field. I have with me also Mr. Maurice Wright, and he's our Chief Investment Officer of the Credit Union Fund Management Company, and therefore he's responsible for the management of the company's investment portfolio and the management of portfolio of clients, including pension funds. I also have with me Miss Kimberly Martin, and she is the head of business development at this very same organization. I want you to relax and enjoy and learn about investment management this afternoon, and then you can call CUFMC and tell us what you think, and also tell us that you have some business and you want us to take care of it for you. So at this point, I'm going to hand over to Andre Yapp, who is going to be talking to you about investing in challenging times.
Okay. Hi, everyone. As Ms. Christie alluded to, I'm Andre Yapp, and I'll be the one bringing you through the investment portion of it, speaking to you about investing in challenging times, right? So just going to start off with an introduction. Essentially, we know that navigating the financial markets can be difficult in the regular and normal times, but know that we're in a more challenging scenario, or challenging environment. It can be even more difficult for the novice investor and even the most expert and seasoned of investors, right? So our intention here is to try to bring you through the presentation to somewhat alleviate some of the anxiety and the lack of knowledge, and to see how best we can make you more comfortable with investing in challenging times, right? So the first thing that we have to kind of establish here is what are challenging times, and are we indeed challenging times? Now, for me, when I think of challenging times, there are a bunch of things that we can have. But what I'm going to touch on are going to be 3 characteristics of challenging times, right? We're going to touch on asymmetry or lack of information, right? We're going to touch on a reduction in economic activity or opportunities in the economic environment, which can cause negative consequences for investors and for the economy as a whole, right? And we're going to speak about the decline in the financial market as well. And these are the 3 characteristics that I'm going to touch on that makes the environment right now challenging, right? So when we think about asymmetry of information or lack of information, it basically speaks to, well, lack of information speaks for itself. Asymmetry basically means that the information is aggregated somewhere else where you have a difficult time getting access to, or you might not actually know about. So some people have it and some people don't. That's what creates the asymmetry, right? So when we think about it, we can think about the coronavirus in this environment. That's pretty much what has been the catalyst to our challenging environment right now, right? So a lot of us were caught off guard by the coronavirus and what it actually means for us in terms of investing, what it is, I know personally when it came about, I'm like, well, what name? Where it come from? China? Not reaching over here. 1 week later, it's in Italy, and it's crazy. A couple days later, it's in the United States, and it's crazy. And then, of course, then it gets here, and we start to see the impact on financial markets all throughout the world, right? Right. So because of the unprecedented nature of the virus, it has had unprecedented effects on the economy, right? So what we're going to try to do is try to figure out what happens. But because it's brand new, it's so new, we don't really know what would have happened or what has happened or what is yet to happen. The fact is that a lot of the things that has happened so far, none of us saw coming. A lot of the things that are going to happen, we won't see coming, and a lot of the things that will happen, we'll only know about it after it happens. I kind of repeated myself there because it's basically the same thought I expressed in 3 different ways, right? So what is unique about the coronavirus is that what it did to the economy is that it caused what we call a supply shock. Generally, when we have an economic shock, it's usually a demand-side economic shock. Essentially, people no longer demand goods because of some event which has happened. Either their income has been slashed or they have lost a job. Some activity or some catalyst led to that. The catalyst to the current economic climate is on the supply side. It's actually on the supply of labor, right? So remember, it started in China. What did China do? They locked down their entire city. People were forced indoors, they weren't working, they weren't producing goods and services, so we have no supply of that type of thing. We have no supply of labor to actually produce goods. And it's actually trickled down everywhere in the world. We've seen it here in Jamaica, where we had quarantines, we had, well, is it quarantine? Yeah, quarantines when we closed down early, right? Yes, so we had quarantines, right? We had situations where people had reduced working hours, so that type of thing. So all of a sudden, we're not producing as much. We had communities which were completely shut down and which were pretty much locked. So these people, they weren't able to go to work to produce goods and services. That negatively impacts the economy. As well, it impacts them because they're not working, so they're not generating an income, so therefore they can't actually patronize businesses. That's quite unique because generally speaking, as I said earlier, we used to demand side shocks, right? So because of that now and the lack of patronage, we have what can be called a vicious cycle, right, where people aren't working, they aren't producing goods and services, they're not patronizing businesses. So now businesses says, well, we don't need as many people as we have working for us anymore because people aren't coming in to buy. And then they lay off people. Those people join that cycle now and they're not buying as much goods and services anymore, and we have a vicious cycle that perpetuates itself, right? The other thing that we can look at now is the economic activity, right? So in terms of economic activity, we can look at the great aggregator of economic activity. We can look at GDP, right? So if we look on the data from Saturday, it's not very positive at the moment, right? In the last quarter, the economy declined by 2.3%. But even before that, which is the fourth quarter, the last quarter of 2019, we saw the economy had a slight contraction. In fact, if you look on the starting report, it doesn't actually give you the percentage, it gives you nominal figures. But when I worked it out, it was less than 1/10 of a percentage. In fact, it was less than 1/2 of a percentage, it was 0.4%, as you can see from the graph there, right? So what that actually aggregates now, because I called it the aggregator of economic activity, it aggregates the closure of the tourism industry, it aggregates shorter working hours, it aggregates all of the negative consequences that we have seen so far. So does that actually look really good? Not really. But we don't have all of the actual factual data yet, right? It's not been published yet, right? So we can look at a bit of anecdotal information, right? So when we think about unemployment, which I touched on why that's a major part of the economy, why we have to be so concerned about unemployment, because unemployment speaks to the ability to consume and not just the ability, but the willingness to consume and to spend money on goods and services, right? When we think about unemployment, that's why it's important. Now, unemployment in January of this year, January 2020, that was at 7.2%, right? However, in about the end of April, beginning of May, right, we had the Minister of Finance said that the Jamaica Care Program, which essentially is just a social program to help to alleviate the distress of displaced workers, had over 400,000 applications. Now we have a labor force of approximately 1.4 million people, not dollars, right? And 400,000 people have claimed for that actual benefit right there. So that implies that at that period in time, the unemployment rate was about 28%. But the CARES program wasn't just for people who are unemployed. They also had one-time beneficiaries, which are the people who are just experiencing economic distress. So they weren't necessarily a part of the labor force to begin with. So let's be generous and say half of those people that applied were a part of that set, that weren't actually a part of the labor force. In that case, the unemployment rate at that time would have been 14%. Right? That's really, really high. It's not really something that we want to see. So that is why we think that right now we'd characterize as somewhat as distressing times, you know? But we can also look at additional anecdotal data, right? So if we look at how that translates into patronage, Now, this data I got from Google. Google is one of my favorite companies in the world. What they have actually done is aggregate their mobility data. So essentially a phone, they use that to track movement. It's not really personally identifiable, so it's just a bunch of people. So it won't say Andre Yapp was at, I don't know, Acropolis when it should have been closed or anything like that, for example. Right? So what it says here is that when you look at particular segments where they have broken down locations by the actual movement and time spent in those locations are down relative to a baseline date. So that baseline date that they have established was prior to COVID. If you go on the website, you'll get more details on how they actually did it. But for the sake of time, I'll skip over that. The baseline date was in January, February, around that period in time, right? So as at July 4th, I think, right? As at July 4th, when you look at recreational retail and that type of stuff, that was down 21% relative to the baseline date. So you're thinking, well, less people are visiting shops. Supermarkets and pharmacies, that's down 12%. So less people are probably going to buy goods and services from the supermarket. Now, you're looking at the graph and you'll notice there's a big dip after May 23rd. Just remember that that's during the Labor Day holiday where the quarantine was, what, at 2 o'clock? Or the shutdown was 2 o'clock, so everybody was pretty much at home the entire weekend by 2 o'clock. So that's why you have that big dip. So it's not necessarily like a misrepresentation or some glitch in the system. Right? If you look on the other parts of the economy, all of them are down. Workplace location, transportation, all of them are down. I don't know how they actually get transportation, to be honest, because the only place that we would have designated as a transportation hub would likely be the transportation center in Halfway Tree, but we can skip. The place that is actually up is households. People are spending more time at home. And if you're spending time at home, you're not spending money elsewhere, right? So we can look at that and say, well, that's kind of why we'd call this, you know, a little bit of troubling time. We can look at the exchange rate. If you look on the exchange rate, we'll see that between the beginning of the year and now, that the exchange rate, the Jamaican dollar has depreciated about 10% relative to the United States dollar, compared to last year, where the entirety of the year was 3.8%, so call it 4%. The year before that, we depreciated about 2.5%. So 10% is quite significant in that context, right? Now, I can't exactly say why. I can speculate as to why. We can say the closure of the tourism industry, that's one of the reasons why we have the dollar running away, because people are anticipating less foreign exchange inflows, because hotels are closed, right? We can also look on it and say, hey, what else could have caused that to go out like this? We can look at other economies. Yes, we have the tourism industries open now, but when we look at other economies who are struggling, who are still under lockdown, who still have COVID like running rampant and spreading, are those people in a position to actually partake in tourism right now, to come to Jamaica, to patronize and spend money there, to increase the inflow? Not necessarily. When we think of remittances as well, are the people who are probably at home not working in a position to send money home, or send money to Jamaica, I should say, to support family and friends or whomever? Are they in a position to do that? No, probably not. So this is probably, notice I said probably, I didn't say definitely. This is probably one of the reasons why we're looking at FX and thinking, wow, it's in a bit of trouble, right? Where the exchange rate is running right there, running rampant. Now, the last point that I mentioned was just, you know, at this distressful financial markets. So if you look on the table, you'll see essentially the performance of the Jamaica Stock Exchange in 2019 to now, and I've had one on the right, which narrows it down to essentially the entirety of 2020. Basically, the main market is down about 28% year to date, and the junior market a little less than that, probably around 25%, right? So the reason why this is important is because it speaks to essentially the confidence in the economy. It's basically one of the other ways in which we manifest how we think that business activity will actually happen going forward, okay? But before we actually touch the meat of the matter, which is how to invest in challenging times, I'd like to do a little bit of housekeeping. And I think this is relevant because you kind of want to do this before challenging times, or you want to start to do this before you start seriously investing, right? So one of the major things that you want to do is to assess your liquidity requirements. Now, I can tell you why liquidity is very, very important. It's one of the things that I like to touch on probably a bit more than the rest. All right, so let's look on it. You're invested in the stock market. You skip this step. You don't worry about your liquidity requirements, right? You go and you said, I want to invest in making big money. I don't want to be liquid. I don't want to invest in those, you know, reasonably safe investments that give me, not so hot of a return. So we're talking about your credit union saving account, your banking account. We're talking about a money market fund like what we offer here at CUFMC or anywhere else. You don't necessarily want to do that because they said those returns aren't hot. The stock market is where it's hot. Stock market is where I hear people getting 100% return. So skip the liquidity requirements, right? Now, technically speaking, what is recommended by the experts is that you generally have 3 to 6 months of your salary in liquids, so you can reach for them in the case of an emergency, such as, what's happening right now. I wouldn't call it an emergency, but challenging times. Now picture this. You skip that step altogether and you invest in the stock market, right? Remember, we just said that the stock market is down about 30% year to date. So you have put all your money and your liquidity in the stock market. Boom. You put your $1 million in there, it's down 30%. Now your $1 million is $700,000, right? You earn $300,000 a month, for example. Just throwing out a nice round figure, okay? So now you lose that money, it's down to 700,000. Now you have 2 months of liquidity, right? You get fired from your job. You have no more income. So essentially you are left with 2 months worth of liquidity. How do you survive? How do you actually take care of yourself? How do you take care of your family? How do you pay your bills? How do you pay your mortgage? How do you buy food? You basically are going to sell all of those assets that you have in the stock market at a loss. Because let's say for argument's sake, you went in at the beginning of the year in January and you've lost that full 30%. You're basically ending up with less money than you had at the beginning, and you have to sell that to somewhat survive. So that's why it's very important for you to establish your liquidity base. It's there to act as a buffer in challenging times. And the fact is that you're likely going to need the buffer more in times of distress than normal. So when times are good, you probably won't even look on it and need it. But when the times are bad, that's when you're going to need it. When the economy goes in the pooper, that's likely when you're going to need it. And that's when you don't want to be just in riskier or risky assets, because, as I said, they have a tendency to decline when the economy goes in the pooper, right? Second thing you want to assess is your risk appetite. Now, your risk appetite is generally comprised of 3 things. Yeah, 3, but why I can only remember 2. All right, so it's basically your risk tolerance, which speaks to, how risky you actually want to get. How much risk are you willing to take, right? It speaks to your ability to absorb risk, and there's another thing. But basically, at the end of the day, what that will inform is what type of assets you should be invested in, right? Or you can be invested in. It puts a cap on it. So it says, okay, this is the maximum amount of risk that this particular individual is willing to take. Now, keep in mind all these things kind of commingle, point 2 and this one right here, which I'm talking about, which is speaking to your investment objective and your investment timeline. Right, those 2 are kind of close. So your objective pretty much speaks for itself. What do you want to do? Is it that you're saving for or you're investing for retirement? You're investing to purchase your first home? And your timeline, how soon do you need the money? Are you purchasing your home next month? Are you purchasing it 5 years from now? Are you retiring 10 years from now, 20 years from now? These things will inform the type of insurance that you can be invested in. And of course, once all of that is taken into calculation, it will basically inform the end result. And at the end, if they don't align, then obviously there's going to have to be some recalibration in 1, 2, or all 3 of the variables. Because, for example, you can't go to a financial, well, maybe you can, but I don't know of any at this moment in time. It's a bit difficult for you to go to a financial institution, right? And said, hey, I was going to throw out the same number, $300,000. There's an apartment complex that's under construction. It's going to be finished in a year, so 12 months from now. And the apartment is $15 million. I need $1.5 million for my deposit. So essentially, you have $300,000. You want it to grow to $1.5 million. So you need your money to grow 5 times over, and you need it within a year. That's not necessarily feasible if you're going to say, well, I need it in a year, and I need no risk whatsoever. Probably not going to work out. And at that point, your advisor will say, hey, we really can't help you in that regard. It'll be very difficult with you saying that you don't want to undertake any risk. Right? And remember that no investments are guaranteed anyway, so don't think that you're going to be guaranteed. Furthermore, you said you want to purchase a home. Are you willing to withstand capital losses? Probably not. So the most obvious thing that would have to be adjusted in that situation would be your timeline. You probably can't buy a home within a year, investing $300,000, hoping to get $1.5 million to buy a home next year. So these things kind of inform each other and they commingle, so to speak, right? So let's get right into the meat of the matter. No, I chose equities because I figured that's what most people would want to hear about, invested in equities in challenging times. What do you actually do? How does it actually work? What is it that me as an investor really need to do, right? So one of the most important things that you're going to have to do in challenging times is to optimize your portfolio as an investor, right? And we're speaking about stocks here, so it's talking about optimizing your equity portfolio, right? So when you're doing that, one of the key considerations that you want to take into account is the business cycle. What stage of the business cycle are we in? Are we in a boom? Are we in a trough? Basically, is the economy growing or is the economy declining or is the economy tanked? Because what your portfolio is going to be weighted in, theoretically speaking, what your portfolio needs to be theoretically weighted in to overperform relative to the other asset classes or other sectors will be determined by the business cycle. So for example, right, if you think about it, you wouldn't necessarily want to be invested in financial stocks during a recession. And that's because financial stocks are optimized to perform during a boom period. So let's think about it. During a boom period, what happens? People are spending money. So how does a financial stock such as a bank benefit? Well, people are spending money and they're swiping the debit card. Boom, I get my service fee, my transaction fee. That goes into the bank accounts and come out in profit on the P&L for you as an investor. How is that a benefit? People want to make large purchases. Okay, we want to buy a car, we want to buy a house. Hey, Mr. Bank, Mr. Credit Union, Mr. Whomever, give me a loan. The bank, credit union, whoever, then turns around and earns interest income. Comes through straight to the bottom line again to you as the investor. All right? Let's flip it around. We're in a recession. Are people going to be shopping willy-nilly? Are they going to be going to clothing stores and buying the hottest, newest outfit? Well, maybe some are. I mean, I won't. Are they going to be buying brand new shoes? Are they going to be buying the best hairstyle? Or are they going to be cutting it down to simply the essentials? I need groceries, I need water, I need to pay my bills, and that's it. So that's not a lot of swiping to get the transaction fee. Are they going to be buying cars? Maybe some will, a lot won't. Because so then the loan fees go away. So you have the commitment fees, all the interest income, all of that goes out the window, right? And then on top of it, they're going to have to deal with non-performing loans because, as we said earlier, people get fired during recessions, unfortunately speaking. I know I say it kind of flippantly, but it's true. It happens. We see it in the economy now. Pick up the newspaper and you'll see it. And they can't service it, right? So it depends on the stage of the economy. It depends. The stage of the economy influences the sector that you're going to be invested in. So let's look at the sectors that we expect to perform well during this period of time, right? So generally speaking, you want to invest in consumer essential goods, right? So you want to invest in companies that manufacture, retail, wholesale, distribute, or do anything of that things with essential goods. Reason being, it doesn't matter if the economy is up or down, people need to eat, people need to shower, people need to do these type of basic things, right? You'd be surprised what people call essential nowadays, all right? So some people, they might say Netflix is an essential good, so, you know, be creative with the way you look at them, right? You want to look at utilities. Reason being, they're going to make their money regardless. You're going to, basically, if they're home more, they're not going out to party, they're not going out to the cinemas, pretty much because they're closed, because of COVID, like now, unfortunately, and we're bored, right? So they're going to run up a light bill. I mean, we see it in the news right now. All right, everybody's bawling about JPS bill. JPS is saying, no, we're not robbing you. It's the usage that's high. I don't know who is right. I don't know who is telling the truth. I don't know who is lying. I won't comment because I can't afford a lawsuit, right? So utilities tend to perform well during that period of time. And the reason why I say regulated utilities is because their fee is pretty much set. It's not going to fluctuate, right? It's there in regulation. Now, what you want to avoid now during distressing times or challenging times, as we have called it, you want to avoid discretionary goods, right? So you want to avoid travel, leisure, luxury, right? Because people aren't likely going to spend their money on that during times where, you know, things are a bit meager, you know, right? You're going to avoid real estate, even REITs. Reason being, if businesses aren't getting patronized, how are they going to pay the rent? How is the REIT going to get the income stream rolling in, right? You want to avoid the financial sector for the reasons that I just expressed there previously, right? Now, you want to narrow it down now, but how do you narrow it down? So this is how I think that people should narrow it down, not just based on sector, but based on companies within particular sectors, right? You want to select companies with good, strong balance sheets. Now, the reason why balance sheets are so important is because balance sheets are one of the strongest indicators that you will have of business continuity, okay? So you want to look at your liquidity ratios, your solvency ratios. I'm talking about your liquidity ratio. Yeah, current ratio is nice and all that, but what you really want to look on is your quick ratio, your acid test ratio, right? The reason why you're looking at that is because that ratio discounts inventory. So you're looking at the company's ability to actually meet its short-term liabilities without it selling inventory. And the reason why you don't want inventory in there is because things kind of rough right now. People not really coming in, customers not coming in to buy goods, and we're stuck with the inventory. So can you meet your short-term obligations without selling the inventory? So that's why I say in that time you want to look at your asset test ratio more than your current ratio, right? The other thing you want to look at are counter-cyclical companies. Basically, companies that do well in recession. I know I touched on this already, but we want to touch on it again. You don't necessarily want companies that move with the business cycle. You want companies that move counter to the business cycle. So when the economy is down, these are the companies that will flourish. When the economy is up, cyclical companies will be up, but counter-cyclical companies will be down, right? You want to look at companies with a strong history of paying dividends. The reason why you want dividends is because cash is king. We spoke to liquidity earlier. You want that coming in to somewhat give you some return on your investment because, as we mentioned earlier, the market might not be so giving during that period of time. So this is a way to actually get something back from the market. And like I said, it helps to bolster your liquidity, right? So it makes it a little bit more safer and secure. And of course, kingpin of them all, diversification is key. And the reason why we want to look at diversification is pretty much what I said earlier when we were talking about cyclical and counter-cyclical companies. The fact of the matter is we don't know and we can't predict exactly when the business cycle will shift. So if you are investing and you said, you know what, we're in a downturn, I'm going to put my money in all counter-cyclical companies because these are the companies that will perform well in a recession. And then tomorrow it's no longer a recession. And those companies decline and the other ones, the cyclical companies start to do well. You don't know. So you might want to shift the weighting along. And you might want to still have exposure to companies that won't necessarily do well, but still adheres to having a good balance sheet, that have a strong history of paying dividends. Because when the economy shifts, which you can't predict and you can't say when, these are the companies that will give you extraordinary returns, right? So diversification will still be key. And on top of it, you never want to eggs in one basket, right? So that's pretty much the conclusion of my presentation, right? So challenging times, they don't really last forever. They don't. Because if they did, human race would have dead long time. Dinosaur would have named way. And just asteroid would have burned way up. Everything would have gone. Challenging times, they don't last forever. Not in actuality, not in financial markets. They come and they go. I can't tell you when it's going to go. I wish I could. I'd make a lot of money if I could. In fact, I wouldn't tell you. I'd keep the information for myself and make a lot of money. But these things come and go, right? So with that said and done, passing it on to Maurice for his part of the presentation where I speak to you about the QMAX unit trust funds. Maurice?
Thank you, Andre. Good afternoon, ladies and gentlemen. As you know, the financial market is in transition in Jamaica, where we're essentially moving from a repo-centric market to a collective investment scheme being a more dominant product in the market. Now, there are two types of collective investment schemes. One is a unit trust, which we'll focus on here. The other is runs from 0 days to typically 90 days. The long-term ones, such as real estate, unit trust, and so on, those are like 3 years. But the typical period is between 30 days and 90 days. So you will have access to your initial investment fairly quickly. The other benefit is that of liquidity. As I pointed out, you can access your funds in fairly quick order. So if there are emergencies, you can withdraw some of your subscription. You also benefit from the management. You get the expertise of the fund manager, who typically has a team of experts to do the analysis and to trade on behalf of this collective investment scheme, the unit trust. And so this is a good feature of it. The unit trust also offers diversification in the sense that it will have limits in terms of the different asset classes that it can participate in, or even if it's just a fixed income, the different subclasses, so government instruments, repurchase agreements, corporate bonds, and so on. So you will whatever the type of unit trust it is, you'll have different classes, subclasses being available. You also have reduced fees in the unit trust. Typically, the most some fund managers charge is 2%. The typical amount is between 1 and 1.5%. So the unit trust offers good benefits. In addition, it offers the average investor who would typically not have access to, let's say, certain bonds. It would give them access to that because the monies of the unit holders are pooled together to buy the particular asset. Now, what are the products that in this class that CUFMC has? CUFMC is currently approved to offer 6 unit trusts. We currently have 4 operational. The 4 operational ones are the liquidity fund, and I'll speak specifically about each of them in a few minutes. The liquidity fund, the QMAX money market fund, the QMAX FX fund, FX means foreign exchange, and the QMAX FX bond fund. I'll get into each of these. The money market fund is essentially a short to medium term fund. So it's targeted at investors with that kind of time horizon. The subscription amount is typically, well, the minimum is $50,000, and that's the initial subscription. The subsequent subscription is $10,000. So you can start with $50,000, and that's Jamaican dollars, I'm sorry. Jamaican dollars, and then each subsequent investment is $10,000. The composition of the fund is typically the usual fixed income instruments, GOJ, which is Government of Jamaica instrument, the Bank of Jamaica instruments, BOJ, repos, repurchase agreements with other brokers, and a few non-investment grade investments. The holding period for the money market fund is 30 days. So this fund is typically best for persons who are fairly conservative. The FX fund, Andre spoke about what has happened to the exchange rate. Persons want to insulate themselves against the devaluation of the Jamaican dollar, and so they are increasingly holding assets in foreign exchange, typically US dollar. The CUFMC has a fund, the FX fund, which is more short-term in nature, medium to short-term. Those are the persons we target, and that's the time horizon of the fund. It is denominated in US dollar, as I've said, and the minimum to start that one is 500 US dollars. Each subsequent investment should be a minimum of 100 US dollars. The holding period for this one is a little longer, it's 90 days. We're looking for investors, we're targeting investors who are moderate. Another fund that we have, another Jamaican dollar fund, is the liquidity fund. As the name suggests, this one is short-term in nature. This is the one that could be used to address the liquidity needs which Andre spoke about earlier. For this one, there's no holding period. The composition of this fund is really short-term instruments. Typically, some repo, some Bank of Jamaica or Government of Jamaica instrument with maturities less than 9 months, and of course some treasury bill. Because it's a liquidity fund, it has no holding period, so you could technically invest today and, well, not technically, actually invest today and withdraw tomorrow. We're not necessarily advocating that, but it's there for you. Again, this is targeted at persons who are conservative. The other fund we have is the FX bond fund. This is more for persons who have a medium to long-term time horizon outlook. This is denominated in US dollars, and it's for persons who want to get some amount of capital appreciation and have as we said, a long-term outlook. The minimum for this one is also 500 US dollars, and subsequent investments should be at least 500 US dollars. So initial investment 500, the same as the subsequent investment. The holding period on this one is 90 days. A little longer because it is used to buy bonds, which are more long-term in nature and probably a little more difficult to sell when subscribers want to withdraw their funds. Again, this fund is targeted at persons with a moderate risk appetite. Those, ladies and gentlemen, are the funds we presently have. In a short while, we're not sure how short is short, we'll be offering a equity fund, and that's one that I think a lot of persons are looking forward to, because that one will get some of the benefits that Andre pointed out that are available when people invest in the stock market. Thank you, ladies and gentlemen. I'll now turn you over to Kimberly.
Thank you, Maurice. So good afternoon, ladies and gentlemen. So I just wanted to talk a little bit about the why, to put some of the information that Maurice and Andre have shared in context. Why are we investing? Why are we here talking about all of these things on a Friday afternoon? So I was hoping to shed a little light on some of that. So to talk about some of those things, we are talking about goals. Why is it that we want to invest? There may be something that you have in mind. You know, you're thinking about that lovely mansion you'd love to purchase, or a nice new car, or perhaps you're thinking about your children's education and being able to put them through school. All of us have different goals. Different things motivate each of us. But the fact is that if we are going to accomplish these goals, more than likely it is going to take a substantial amount of money. So how do we go about amassing these funds, putting them to work so that we can accomplish whatever that goal is that you have in mind, and move it forward? So we've talked about that. We've spoken about the goals. And now we're going to talk about how investing can help you to get to those goals. So investment is just one pathway, one of the ways that you can start to allow your money to work for you and to start the process of building up wealth. And there are many, many different types of investments. We are this afternoon talking about the financial options, you know, the various stocks or bonds or mutual fund products that are available. But the idea, the main premise behind it is just to invest. Find a way to make sure that the money that you earn, that you work so hard for every day, is going to work for you. And then, of course, we all know that there are a few things in our environment that work against us in that regard. So inflation, each time the value of your money decreases as prices increase. So what you could have bought with $100 10 years ago is not the same thing that you can buy with $100 now. How do you combat all of those things? And that is why investing is important, because if you're merely saving, if you're just putting the money away, saving it, earning a very, very low or no rate of return, if you decide to, you know, save it in your savings pan or under the mattress, you're not earning any interest. So that $100 is losing value every day that it's sitting there. The only way to ensure that it's working for you, that you're going to keep up with the pace of inflation, is to make some kind of investment. So I want to encourage you, start today, start right now, call us, talk to one of our financial advisors and start to make that plan. Because if it is that you want to reach those goals that you have in mind, you really just have to make that step and start the process of investing and learning how you can make your money work for you. So the question is, there are many options when you are investing. Why should you come with us here at CUFMC? Well, I'll tell you, there are a number of reasons. We have a wide range of products and services on offer. Some of them we alluded to earlier, the stocks, the bonds, the unit trust, and so on. These are the various products that are available. So we do have the products that can help you to reach these goals. We are very client-centric. You'll have a financial advisor who will be able to guide you in terms of how you invest your funds. We try to make things easy for you by allowing you to send your instructions in by email, so no long lines, no waiting, just send us your instructions and we can act on those. So we try to make it as easy as possible. So we've had this discussion. We've talked about, you know, the environment. We've talked about some of the products and services. We've talked about the why. Why are we even here talking about all of these things? And if it is that you've decided, you know, I'm going to start this journey, I'm ready to invest, the next question is, how do I do that? You know, it sounds sometimes very, very convoluted. You hear us talking about these stocks and bonds and balance sheets and so on. How do I even get started on this journey? So I'll tell you, it's fairly easy. The first step is to open an account with a brokerage like CUFMC. It only requires a few pieces of information: your ID, TRN, proof of address, information for 2 references, and of course our internal documentation. Just fill those out and then you will be well on your way. Of course, while you're doing all of this, you can speak to one of our financial advisors who can help you to develop a plan of action. How are you going to get started on those many goals that you have? So that is the process. Just bring these items into us. We can get you started and get your account opened. So at this time, we want to take any questions that you may have in relation to any of the presenters, any of the information. So they're going to send me a few questions and I will put them out there and one of the members of the panel will answer your question. Let me see which questions have come up. Okay. So the first question, and I'm going to bring in some of the gentlemen on the panel here, is how do you approach investing? Very broad question. I wonder which one of our panelists would like to take this one. All right. Let me pass the mic over to Maurice. Just a moment.
Well, it's a broad question, but I'll focus it in terms of looking at if you're going to invest, you're going to start at the outset in determining what is your objective. What is it that you want to achieve? And Kimberly spoke to that earlier. Once you have that in mind, you'll look to see what you'll have to first understand what is your own risk appetite, because that will inform what kind of asset you ought to invest in. Even something as simple as the the unit trust products that we just outlined to you. Which one of them would you invest in? That would be dependent on your risk appetite, your objective, and so on. You'll also have to consider your liquidity situation. What are your liquidity needs? You don't want to invest, let's say, in the equities market right now, and then you need the money in 2 weeks, 3 months, because you may have to sell at a loss. You wouldn't want to buy a long-term bond with monies if you have a very high liquidity need, which you can't satisfy from other sources. So that's one way of looking at how you invest. That's how I'd want to characterize it. For me, if you're investing, you have to know what you're investing in. And so I encourage person, even if you're not an expert, read up on it. Read up on the stock market. See how it's doing frequently. You don't have to look at it every 15 minutes. It's not going to appreciate that significantly. But understand what is happening on the stock market. Read analysis of the various companies. Andre spoke about looking at the ratios of company. In a lot of cases, you don't have to do that analysis yourself. The broker houses offer such analysis. So inform yourself with respect to that. For me, the key to investing is taking what I call a portfolio approach. My grandmother would say, don't put your eggs in one basket. It's the same thing she was saying, just less sophisticatedly. Adopt a portfolio approach where you try to acquire assets in the various asset classes. When you're just starting out, you're not necessarily going to be able to buy real estate and so on. But you can start with a fixed income, start with some repos, start with some unit trusts, and so on. As you accumulate more, you get into some bonds and so on. If you're young, particularly those who are young, get into equities, because I think no portfolio is complete, particularly in the Jamaican market, is complete without a little equity. The amount of equity that you put in will change as you get older and so on. But equity has to be in your financial portfolio. I think that's it in a nutshell.
All right. So the next question, I think I will take that one, is asking what is required to open an account. So we ran through that earlier in the presentation. It would require a government issued ID. So either your driver's license or your passport or your voter's ID. You would also need your TRN. And the name and contact number of 2 references. Also proof of address, so something like a utility bill, so that we can prove where you live. Then there are also some internal documents here at CUFMC that you would have to complete. So we would go ahead and have you complete those. And then finally, you would have to deposit the funds that you are going to invest. And after having the discussion with your financial advisor, we would determine what particular product you would be invested in. So that would be the process to open an account. Just going to check if there are any other questions. we do have one. This one is asking, how well do you expect the stock market to do this year? Anybody want to take that one? I think Andre is going to take it.
All right. So here's the thing. Anybody that you ask that question to, what they're going to give you is a guess. It's not going to be educated. It's not going to be worth anything. Like, you can't take it to the bank. You can't ever sell it. It's not really worth anything. So any answer that anybody gives you, it's a guess. It really doesn't hold any water. It's worse than a basket. It's basically air. It's air trying to hold water. Right? So I can't say. Nobody can say. Anybody that tell you that, them trying to sell a loom. All right, it's very speculative at this point. I mean, I think I touched on it in the presentation when I said that there's a lack of information, right? So when we speak of the lack of information, we're speaking about essentially how deeply impacted will the economy be? Because the market is going to be a reflection of the economy. How deeply impacted will the market be? Will the economy be? How long will it last? When will things start to normalize? As you see right now, it's July and we're still maintaining social distancing. We still have some curfews in place. Granted, it's at 11 o'clock now. We still have restrictive things. These things weigh on an economy. I'm not criticizing them, absolutely not, because I think they're essential for keeping us safe on a personal note. But, you know, it's hard to say. Just honestly can't say. I mean, I can throw out an arbitrary number, which means absolutely nothing if it makes you feel better. I think the market would do 15% this year. It's random. I don't really think that, but just to throw out an arbitrary number. You know? Sorry, can't answer in any meaningful way.
All right, so we are going to take the last question now, and that one is, what, if any, opportunities are there for institutional investors during this time? Any takers? What should institutions be looking out for in terms of investment at this time? I think Maurice will take that one.
Well, for institutional investors, particularly those with a long-term outlook, the equities market, again, the market is down. It's always good to keep your head while others around you are losing theirs. And so there are opportunities to get stocks which are cheap, relatively cheap. But the issue, as Andre has pointed out, we can't tell you that by the end of the year, the market will move up 15% because it's already down by 13%. And so to get to 15% up for the year, it would have to move up by 45% relative to now. We can't say that. But if you have a long-term outlook and you can buy equities, you can be purchasing a lot of equities. And in 2-3 years, think long-term, 2-3 years or 4 or 5, you should be doing very well because we expect things to rebound. It is said that the tourism market will not rebound until about 2 years. If you have a medium to long-term outlook, then the stock market is a good place for you to buy. If you're interested in global bonds, the Jamaican global bonds, which in March, April went down significantly, bounced back towards the end of May and has been going up significantly. So you can make significant levels of money trading GOJ, US dollar global bonds, which are listed on the US market. So I'd point persons in that direction. But there are other opportunities in Jamaica. Right now, there are a number of companies, again in the stock market, looking to have IPOs and APOs. There are those opportunities, but you have to have a long-term outlook. If your outlook is until the end of the year, it's likely to be speculative. Okay.
Thank you for that, Maurice. So the last question we're seeing here is there a minimum to open an equity account? And the answer to that question is no. Just bring the funds and we will make it work for you. There is no minimum to open an equity account with CUFMC. And on that note, I just want to extend a thank you to our presenters for being here this evening. And of course, a thank you to all of our viewers on social media. Thank you for tuning in and listening and participating with your questions. And we look forward to seeing you again. We hope you can tune in to our follow-up webinar, which is scheduled for August 21st. We hope we will see you then, where we can talk some more about financial matters and how we can assist you to achieve your financial goals. So have a good evening, enjoy your weekend, and thanks again for tuning in.